Hi everyone, I'm Clodagh Muldoon, Head of Research at Climate Bonds Initiative. I'm delighted that you could join us today and very much looking forward to introducing Climate Bond's most recent report on transparency and reporting on the GSS bond market. With support from multiple sponsors, including IFC, SGX Group, S&P Global Ratings, and the Global Methane Hub. On this occasion, Climate Bonds assessed a wider range of instruments from a larger issuer base than in previous studies. And importantly, the findings are broadly positive. That said, there is still a lot of work to be done. I'm joined today by an expert panel, including Christina Sewell from S&P Global Ratings, Christina is a senior analyst in the Sustainable Finance Group at S&P Global Ratings. She leads innovation in sustainable finance through the development of new products that support the transition to a low-carbon, climate-resilient future. Christina conducts research and analysis on market trends and regulations that inform S&P Global's sustainable finance strategy, and she has led second-party opinions on sustainable labeled debt, advising a wide range of public and private entities across various fixed income assets. Alongside Christina, we have Kathy McNano, who joins us from IFC. Kathy is a sustainable finance specialist based in Washington, D.C. Kathy works across the institution to advance the inclusiveness of IFC's investments through the use of social and other innovative finance instruments. Kathy represents IFCs on ICMA's executive committee for the green, social, and sustainability linked bond principles and is the technical expert for the IFC's 11 billion USD social bond program. Additionally, Samuel Gann joins us from SGX Group, where he is the head of debt capital markets with responsibility for debt listings business of the exchange. In his role, Samuel covers debt issuers, intermediaries, including banks and law firms, as well as development and ecosystem partners. I'm looking forward to a really insightful discussion with the panelists and sharing and hearing all of their insights and perspectives from a wide range of roles. And so thank you to all of the panelists, and even more so because you come from various different locations, which means it's really, really early for some of you and very late for some of you. So thank you so much for making the time to share your thoughts with us. With regard to this report, the Transparency and Reporting in the GSS Bond Market Report contains many interesting results from the analysis conducted, showcases best practice examples, and highlights recommendations as to what can be done to move things forwards. The report's aim was to assess the landscape of reporting on both allocations and impacts, to celebrate progress, identify gaps, and also to suggest recommendations for improvement. Climate Bonds on this occasion has assessed GSS deals priced between 2020 and 2023, totaling 1.4 trillion US dollars, issued, which covers more than 5,000 bonds. And these were all assessed and were considered to be aligned with Climate Bonds' green, social, and sustainability methodologies. The survey sample covers 75 of the largest issuers globally of GSS bonds across all issuer types during that period. So to some of the highlights, the analysis showed that while the quality of reporting varies widely, it is generally high and has improved considerably since our last study in 2021. There were increased levels of commitment to report across the issuer sample in both allocations and impacts, with 93% of the issuers surveyed committed to both impacts and allocations. 91% of issuers published dedicated GSS reports, often annually, and 60% of issuers were found to have accessible, easy to find reports, which is hugely important. By issuer type, sovereigns and local governments in particular demonstrated an improvement in transparency of reporting, as well as the adoption of best practices, building on our findings in the previous study in 2021. ICMA's project classification was by far the most frequently used to categorize projects, with 80% of issuers surveyed referencing and relying upon ICMA's guidance and principles. And additionally, although impact reporting still lags that of allocation reporting, in many aspects, ICMA's harmonized framework for green bond reporting was the most frequently cited. So to our findings, we also noted that there are some key gaps remaining in post-issuance reporting and areas for improvement, which we will touch upon later in this discussion with our panel. As a starting point, our highlights from the report were that there's an ongoing lack of standardization and an absence of granularity in impact metrics. A notable lack of standardization across all aspects of reporting, including frequency, content, and reference to frameworks. The lack of universal reporting standards and inconsistent reporting methodology make it really difficult for investors to assess and compare projects, which means that there's a lot of corporates out there going to extreme lengths to really try and facilitate their disclosure efforts without it actually achieving what they wanted to achieve. We would like to see an increased granularity in impact metrics as well. Different issuers use varied KPIs, calculation methods, assumptions, and baselines, creating a real confusion in and undermining the effectiveness of the market. In the report, Climate Bonds has also suggested a list of recommendations for high quality and standardized reporting. And at a minimum, we propose 4 elements. These include scope, the need to report on both allocations and impacts, bond identification. Please clearly state the scope of the reports in terms of the instruments and the period covered. Percentage of proceeds allocated and the associated impact to those instruments is also really, really welcomed. Accessibility to disclosure, make disclosure easy to allocate. Frequency and timing be very consistent and clear. There are still opportunities to strengthen reporting in multiple areas, including more widespread use of the ICMA harmonized frameworks, dedicated sustainable finance web pages with documents clearly listed on issuer websites. Also, project level disclosure would be ideal. Reference to taxonomies used, and the clarity on the description of impact indicators and impact assessment methodologies would be really helpful. And please also, the use of external reviews is really, really, really helpful, as some of our panelists might allude to today. And now to our esteemed panel. To start the discussion, I would like to begin with a question to all of the panelists. One area that I've mentioned and that has been mentioned time and time again in relation to reporting is the need for transparency and standardization. I'd love to ask the panel, has this been your experience? If so, what can issuers do and what can those supporting issuance do to meet investors' needs in the most effective way? I might start with you, Christina, if that's okay.
Sure, yes. Thank you so much, Clodagh. It's really great to be here on behalf of S&P with you, Samuel and Kathy, and everyone who's tuned in today. I think from our perspective as an external reviewer of post-issuance reporting, similarly to like what you just mentioned, reviewing some of the report findings from CBI, at S&P, we're also saying that there are some clear improvements with reporting in recent years, but definitely still some challenges remaining around, not only is the data transparent and accessible on a regular basis to investors and bondholders, but also is it comparable? As you alluded to, is it decision useful information? And so one of the biggest challenges that I think that we continue to hear from asset managers globally is post-issuance reports still a little bit difficult to track over time, especially as bonds are moving into their second or third year of maturity. That's when you often start to see the progress reports begin to fall off, which leads to some data integrity issues, especially in the secondary bond market. It's also been our observation as a reviewer that even when the post-issuance reports are made available on a regular basis to those bondholders, they might lack those more granular details that are really important about how the funds exactly were allocated as it relates to that particular bond, that instrument in question, with accurate prorating to the financing that's at play. And then I think also complementary to that, from a standardization perspective, you just touched on this too, Clodagh, the market has to be able to understand how the project impacts were really being measured. Were the metrics that were chosen for that particular project the most material for that project type? Were they expressed in a way that is very much aligned to the industry standards, so many of which we see proliferating out there with a credible calculation methodology that's cited. So for S&P, we're facilitators of the market as an external reviewer. We're really interested in trying to help facilitate not only more quantity of data over time, but also looking at that quality and actionability of what's being reported, so that we're looking at apples to apples for investor reporting.
And Samuel, can I hand over to you maybe, and if you could share some of your insights and experience?
Sure. Thanks, Clodagh, and thanks for having me. Great to be here. Just like to reiterate the point that you, Clodagh, made earlier about the importance of post-issuance reports being published in a timely manner and to be easily accessible, ideally, on the sustainable finance section of the issuer's website or on the stock exchange disclosure platform. In an ideal world, investors would like to see issuers have dedicated sustainability teams that proactively engage with investors and are responsive to investor questions about post-issuance reporting. But it's easier for larger and more frequent issuers who can afford to have such dedicated resources, but it will be more challenging for smaller companies or issuers with only one or two labeled bonds outstanding who may find it difficult to justify the expense and the resources.
Thank you so much, Samuel. And can I go to you, Kathy, to share your experience?
Yeah, sure. Thanks, Clodagh, and thanks for having us here, and congrats on the launch of the report. I totally agree in terms of what you're hearing in terms on standardization, and even more so when it comes to social, which is where I've been focusing. So it's I feel like just amplified in those conversations. What I hear from investors is they really want to be able to aggregate social impact across their portfolios. So they want numbers that they can aggregate, which is very challenging when there's so many different types of social projects that could be eligible. But when they're looking for one figure that can be aggregated across all social projects, like a lot of times they're falling to number of beneficiaries. I think this kind of came out in the report as well. So I think issuers need to be cognizant of that. If that's what is being asked for from investors, they need to know what's really needed and what's going to be used, because I've seen some issuers with very long and extensive impact reports, but quite costly to put together and take quite a bit of resources. I'm not sure if all of that data is getting used. So I feel like there's a bit of kind of bridging that gap in terms of what's being produced and what's actually being used. In terms of guidance, what you mentioned, we've been working through ICMA on the impact reporting group that focuses on social bonds. So we've been trying to address some of these standardization issues through that group for the last year or two now. Last year, we put out more guidance on affordable housing. So really trying to standardize what's coming out in affordable housing and trying to put together annexes to that harmonized framework that go category by category. So this year, together with World Bank and BNP, we're working on access to essential services, so health, education, and access to finance. So trying to come up with core and other metrics similar to what came out last year on housing, but really going away from the kind of the long lists of output, outcome, impact indicators that some found to be a bit confusing, to really trying to hone in on a couple of core metrics that can be usable across most types of projects, in the hopes that can kind of support and can contribute to more harmonization and standardization, which is what is being asked for.
And we might touch again upon that point of where there needs to be like a more of a regional tilt slightly later in the conversation, because it would be really interesting to hear your input, Kathy, from what you've seen on the social aspect. So for my second question, I was wondering what the panel see as the key gaps, and I think we have touched upon some of these already. They currently exist in post-issuance reporting. And maybe, Christina, if you can share your insights here, and Kathy, from a social perspective, what do you think could really move that market forward in the way that we have seen the green debt market and maybe some of the more science-based markets move forward?
Yeah, I can start here. I think kind of just following up on what everyone's been discussing already, the most significant gap probably comes down to just more standardizable KPIs that are being reported. I think from the green project side of the house right now, because that's where we focus on right now for post-issuance reviews at S&P, you have a variety of metrics, sometimes that are being reported by different peer groups that are financing similar type of projects, and the KPIs seem very similar at first glance, but then you often come to find like these are not quite comparable across maybe the same project type. So just as an example, you might have several different KPIs for a renewable energy project, say a hydropower plant. Issuer A might report on what are the avoided emissions in metric tons of CO2 equivalent. Then their peer issuer B is only reporting on what is the energy generated in megawatt hours for that project. And then thirdly, you might have another issuer that's talking about efficiency gains only, or only looking at the emissions intensity of the plant without citing some absolute kind of greenhouse gas emissions figures. So you can see, like from an example like that, just kind of how complex this standardization begins to get to assess, as Kathy was referring to at the aggregated level and both at the project level. So it's not to say, we're not here to say that there's only one right way of reporting something, but that the market needs to be able to find some common ground as much as possible and follow the industry standards for reporting that are laid out in various best practice frameworks. And so I will say that these are precisely the kinds of issues and questions that S&P would make sure to communicate with our clients, discuss with our clients in our post-issuance report review management meetings. And that's why we feel very strongly that external reviews offer the market that can offer the market more context on the quality and the standardization, the interoperability of the reporting are so important, Clodagh, especially at this early stage of post-issuance reports where there's still quite a bit of fragmentation that we see.
And Kathy, would you like to offer some thoughts from your side?
Yeah, I mean, I think from the social perspective, the whole idea on more disclosure around methodologies, it's all very similar, reflected there. I mean, just going back to the kind of this more common indicator around number of beneficiaries that we're starting to see. When I was reading the report, it kind of struck me a little bit because it was described as being a relatively straightforward indicator. But really, when you start to think about it, it can be very complicated depending on the type of project that you're trying to measure. And so I feel like there needs to be more attention on some of these social indicators that at first glance are very straightforward, but when you dive into it, they can be representing many different things. So for example, affordable housing, if you think about, is one housing unit equivalent to one beneficiary? Is this being multiplied by 4 or 5 to reflect an average household size? I mean, this has big implications on the number of people being reached. Or if you're in health, for example, if you're constructing a hospital, trying to translate that into a number of beneficiaries, is that looking at number of beds, length of stay, occupancy rate, all of these different things, what's being taken into account when you're translating some of these things into a number of beneficiaries? Are we starting from baseline of 0? Is there already something that we're building off of? So I feel like if the social space is trying to, or at least some social investors are really trying to use this indicator as one of their key indicators, really need to make sure that it's credible, comparable. Christina, similar to the things that you were mentioning, really make sure that this is a useful number and that it's actually representing the same type of impact as much as possible across projects.
And also, I guess, on some of the social aspects it could be slightly more difficult for issuers to recognize what good looks like, what credible looks like. So getting that guidance maybe from us working together as many people working in slightly different fields in giving that guidance would be really helpful to say, okay, this is a credible metric, this is not, because I think social often lends itself to being just slightly more nuanced in certain areas and might be more difficult for issuers to come up with what they think is ambitious enough. So just moving on momentarily from that, what do we think could be the kind of drivers behind reaching or finding potential solutions for improving reporting quality and market integrity? I think many of these questions are kind of overlapped, but if you had a kind of a hit list of things that you would ask from issuers, what would they be? Can we go to Christina first? Yeah.
Sure. Yeah. I think, at S&P, we feel strongly that one of the biggest solutions for improving reporting quality is in stronger accountability mechanisms for the issuer. And I think, what we rely on as a second party opinion provider and an external reviewer at post-issuance is, more adoption of credible industry guidance to help improve that transparency and standardization. So, we're really thankful that we're seeing a lot of progress in both the development and the adoption now of best practices for reporting in recent years. Thanks to white papers like CBI's that are educating on these issues and trends on a regular basis, as well as the continued efforts of IFRS, S1 and S2 sustainability accounting standards, ICMA's harmonized framework on reporting for green and now social projects, which is wonderful. Or an issuer who's in a different region, like the Nordics, might be more privy to like the NPSI paper on reporting. And I think that's also complemented by many environmental impact accounting standards for sector-specific type of projects. They have, or asset classes like the IPCC's guidelines on national greenhouse gas inventories, which we recommend that sovereigns use to do their reporting, PCAF reporting standard guidance for FIs and banks. So there's a lot of resource here that we also draw on in our external reports. Kind of outside of that, I think that there's technologies too, like AI-enabled databases now, blockchain, remote sensing. We're always talking about them. They're always kind of developing in the ether, but I think, increasingly as now ChatGPT and other AI tools have taken off, we're going to see a lot more real-time tracking of environmental outcomes, which is really exciting. But yeah, I just really want to hit home that like S&P, we think we're getting closer to a comparable post-issuance reporting landscape. We're really trying to help facilitate that as an external reviewer. And I think, again, at this early stage in the market's kind of coalescence, cohesion around impact reporting, external reviews can do a lot of good as a solution for issuers, especially when we're kind of going beyond the simple validation of where the financial flows are going, but also offering some more in-depth context, just as we do at the SPO stage, about the quality of the reported data, talking about, did the issuer align to its pre-issuance commitments? Did it align to the eligibility criteria? Is it following best practice frameworks and guidance? So yeah, that's kind of what we're looking at right now, is like more accountability, and how do we support that as a facilitator in the market?
Excellent. Thank you so much. And Samuel, I don't know if you'd like to shine a light on some of the work that SGX Group is doing, and also if you could add any insights from some of the market participants that you work with.
Sure, very happy to. And maybe to take a step back for the benefit of the audience who may be less familiar with SGX Group, we are a multi-asset exchange and a listing venue for both equity and debt securities. On the equity side, we have over 600 listed companies on our exchange, and on the fixed income side, we are the most active listing venue for international bonds in Asia Pacific, and have about 6,000 outstanding listed bonds. SGX also has a regulatory function that's undertaken by Singapore Exchange Regulation, or SGX RegCo for short. It is an independent subsidiary of SGX with its own CEO and board of directors. So for our listed equity issuers, we have enhanced our sustainability reporting regime to incorporate the latest ISSB standards. And we have also introduced what we call the SGX 27 Core ESG Matrix that covers a range of ESG factors that are commonly associated, or rather considered material by investors and stakeholders. Companies are encouraged to report against these 27 matrix to allow consistency and comparability of sustainability disclosures, though this is not mandatory. We have also launched an ESG disclosure platform that is called ESG Gnome, that's available free of charge to our listed companies to support them in their ESG related disclosures, data collection, tracking, as well as reporting. On the fixed income side, I think we have launched SGX Sustainable Fixed Income Initiative. This initiative recognizes green, social, and sustainability bonds that are listed on SGX that meet recognized international standards. And one of the requirements to maintain recognition under this initiative would be for issuers to publish post-issuance reports as required under the relevant standards, and for these reports to be publicly available. We are also grateful for the active and supportive role that our regulators play. For example, in Singapore, the Monetary Authority of Singapore, which is our central bank and financial markets regulator, they have been very supportive in encouraging the issuance of labeled bonds, including grant schemes for sustainable bonds and loans that cover the cost of pre-issuance external reviews, as well as post-issuance external review and reporting. And of course, not to forget the work that MDBs such as the IFC, ADB, and World Bank have been doing in providing technical assistance and support to issuers across the region. For example, the World Bank Treasury provided technical assistance to the ASEAN Capital Markets Forum in developing the regional green and social bond standards. And the IFC has also been had the Green Bond Technical Assistance Program, and has done a lot of good work with labeled bond issuance from the private sector in developing countries.
Excellent. Thank you so much. So I mean, it seems to me so far that I think an entirely collaborative effort will be needed to really drive this market forward. And I'm delighted to think with your participation today that that's exactly what we're trying to aim for. I'd love to know, and this is one thing that we tried to look into a little bit, but we didn't go in depthly into in the report, was do you, in your experience, see regional differences in what's being reported? And also, some of the barriers that companies face in different regions as to what they're expected or what they can report upon would be really, really interesting to hear your thoughts of. I don't know, Christina, if you'd like to start from your experience.
Sure. Yeah, I think in the context of green bonds, at least, which we review the most of, at least at the post-issuance stage currently, intuitively, we'll see that regions with larger, more mature markets have more sophisticated post-issuance reporting naturally. I think in the Nordics, especially, and across Europe, there's a high level of maturity and post-issuance reporting and sophistication there. And that seems to be driven by these regulatory frameworks that we're seeing more and more of. Of course, we have the EU Green Bond Standard now. That's related to the EU taxonomy, the CSRD regulation for issuers that's coming into play this year. So all of that, I think, is pushing issuers to think about how to kind of make more cohesive and more granular their reporting against those frameworks. And also, as it relates to the EUGB, it does necessitate that third-party external review, which is going to improve accountability there. In contrast, I'm based in California, and I think practices in North America are still quite evolving and catching up to Europe. I think I can say, we've been a little bit less consistent across the board in the US, especially among muni issuers, I think. And oftentimes, the reporting that might be available across the board, it could be, kind of more based on what are the straight outputs of the projects, what are the exact figures that came out from the project through qualitative and sometimes through like narrative-based case studies, more so than you might see from more long-term projected or measured impacts and more quantitative data. And I think especially that's the case for social bonds and social projects, which it's a little bit more difficult there, right, to get those kind of quantitative figures, because you would have to do like a whole regressive analysis for that. And as it relates to affordable housing and social mobility project types, Kathy, you can speak to this better than I, but we have a lot more kind of like straight output reporting, especially in the US. But I think, yeah, always a lot more growing demand for standardization, for transparency from investors in the US as well. And we're seeing some improved reporting across use of proceeds instruments. One other thing I would say is with the rise of regional taxonomies, for example, in APAC, you have the growing common ground taxonomy now between China, the EU, and Singapore most recently. Several different LATAM taxonomies continuing to prop up in the emerging markets. I think that's also going to translate to more improved reporting practices across these regions. But Samuel, I'm sure you know a lot more about that landscape.
Samuel, we'll hand it over to you to shed some light from your perspective.
Sure. So being at SGX and based in Singapore, perhaps I can offer a perspective on Asia Pacific. As you well know, Asia Pacific is a very large and diverse region with different countries at different stages of development and capital markets maturity. At the one end, you have advanced economies like Japan, South Korea, which have very developed local sustainable bond markets, and whose issuers are also frequent issuers of labeled bonds in the international bond markets. And I think we generally observe that issuers from these countries, to a large extent, align with international best practices for both their impact and for both the allocation and impact reporting. On the other hand, there are also many emerging economies in the region that are still building capacity, especially for more complex impact assessments and face challenges, including limited access to reliable and standardized sustainability data. There are also more, compared to other regions, more smaller companies in Asia Pacific who may face cost and resource constraints in terms of post-issuance reporting and other sustainability reporting. And as I mentioned earlier, there may be less regular issuers of labeled bonds and may have only 1 or 2 bonds outstanding, which may make it more difficult for them to justify the cost of having dedicated teams to look after post-issuance reporting. I mean, that said, to the point I made earlier as well, MVBs have been doing a lot of good work on this front. They play a very important role in bridging this gap by providing technical assistance to emerging market issuers, both at the pre-issuance stage in terms of putting together the sustainable bond framework, helping them access the labeled bond markets, as well as the post-issuance stage in terms of informing them of expectations of what investors expect on post-issuance reporting and actually helping them put together the allocation and impact reports.
Excellent. And can I ask you, Kathy, from your perspective, looking more specifically at the social side of things, have you noticed a discernible trend in the amount that's being disclosed in different regions, or not quite yet?
I mean, honestly, not really. And we haven't done a deep dive on this topic, to be fair, but I haven't seen anything coming out. Obviously, we focus on emerging markets. I haven't seen anything coming out saying that there's less coming from emerging markets than others. I think that, as Samuel is saying, IFC has been doing a lot of technical assistance focused on this type of area, but I mean, I think in general, it's maybe a newer issuer type of thing, is that's kind of getting the reporting kind of processes up and running, maybe less than regional. That's just my thought anyway. I mean, obviously across regions, you see them relying on the local definitions. So important for social. So, income thresholds and things like that. So you see them pulling in different things from different regions, but I don't know if I'd say that any particular areas more advanced or less advanced.
And do you think because it's based on local issues, do you think that poses a barrier for comparability?
I wouldn't say so. I mean, I feel like the issues, I mean, the nuances of that issue might be very local. But a lot of these are global issues. I mean, health, housing, education, all of these are things that are faced all over. So I don't think that there's I don't think that there would be any particular nuance in one region versus that's not being faced in another. How they address it might be different. It's probably different, but I don't know if that would be a barrier per se.
Or what might be deemed to be, I guess, ambitious or credible in one region might be different to another region. And that's probably something that's going to be explored going forward. I don't know, Christina, if you've come up against that in your role of having to add kind of local and regional nuances to what you're looking at and what you're deeming as ambitious and credible.
Absolutely, Clodagh. I think, there's just so many dozens of taxonomies that we see now propping up globally, and a lot more issuers that are citing alignment to their green label by, attaching that alignment to the taxonomy at play. There's a lot of harmonization that's happening there at the regional level, but I think we need a little bit kind of more convergence, at least at the ESG kind of rating and second party opinion provider level, to understand, okay, how do all of these taxonomies kind of fit together? How do they apply to the green and sustainable labels that we're assessing issuers' projects against? And so that's something that we're talking about a lot internally right now, is just kind of like crosswalking our thinking about how the ICMA principles apply to all of these regional trends occurring across the board. And thankfully, I think with the common ground taxonomy between China, EU, and Singapore, and hopefully more joint frameworks like this, we'll see a bit more harmonization there.
Thank you so much for that. And there
Can
have been a couple of questions.
I just jump in on that one, Clodagh,
Of
before we
course, yeah, of
go over the
course.
questions? No, I just wanted to comment because I mean, you raise a really valid point, and I feel like some of this around the local nuances on social is around how you define the social issue upfront.
Yeah.
And so the reporting may or may not be different, but it's how you define it upfront in what is an issue in your context that kind of sets the stage for all of the reporting that follows. And then in terms of ambitiousness, I feel like that's really on the sustainability linked side, when you see a lot of comparing what's your baseline, where are you going, what are your peers in the country doing, comparing that. I feel like that is something where it is a challenge on the social side, because we're seeing a lot of comparisons across regions when those are so different. So I feel like there is where we're really facing a lot of challenges in terms of benchmarking ambitiousness for social.
Yeah, I totally agree. And I see this as an area that's really going to have to be, which I'm sure you do every day, Kathy, is going to have to be explored further and further as we go forward. And I think one of the things in our lead up conversations to this call is that we were all very conscious of us looking at and highlighting the development of the green bond market as well as the other labeled debt markets, but also making a kind of saying that this is an opportunity for us to make sure that we learn from the lessons that we've learned in the green bond market, because it has developed a little bit more quickly than some of the other markets. And so, like what you're saying to Kathy, that maybe we should really explore these elements of the social market now and try and really have a good in-depth look at what good and ambitious and credible looks like. So we don't ultimately end up in issuers spending a lot of time reporting on elements that are just not really that useful or wanted by investors or necessary to investors, let's say. We've had a couple of questions come in, and I'd love to know, have any of the panelists noticed any specific trends from a sector, so not regional perspective, but a sector perspective with regards to reporting? And have they noticed that it's easier for some sectors rather than others to report? Christina, can I go to you first?
Yeah, no, I think we've definitely seen some sector specific trends in the demand, in the investor demand for post-issuance reporting. And so I think that also translates to, more harmonized reporting for some sectors. For instance, in renewable energy, for one, investors are very focused on what are the actual energy generation figures? What are the emissions reductions? We call that scope 4. What are the avoided emissions related to projects such as renewable energy projects like wind and solar projects? So we see a lot of good data there. Clean transportation is also another one with a lot of growing demand, especially as we see more EV fleet deployment, and also how its charging infrastructure kind of relates to those figures as well, and how it relates to the issuer's broader decarbonization goals is really important for investors to understand. Real estate is another one where there is kind of like a lot of fragmentation still, based on what region you're reporting from. You could be using labels like, I think it's Green Star or LEED, BREEAM, all different types of certifications, and investors are asking for more kind of harmonized figures on energy efficiency and what is the green building standard benchmark that we need to go beyond in order to reach that low carbon climate resilient future, or otherwise a Paris aligned future. And then maybe also like agriculture and land use. I think that there's a lot of interest in the AFOLU space on carbon sequestration what are the long-term impacts of sustainable land management projects, which is oftentimes a little bit more difficult for issuers to report on because the local context is so important for nature-based ag-related projects. But hopefully with the advent of more tracking systems and AI kind of enabled data, we'll see some more specific figures there as well.
Excellent. Thank you so much. And Samuel, can I ask you from your perspective, what have you seen?
Sure. So from what we're seeing in Asia Pacific, a lot of the green bond issuers tend to be banks or real estate companies. And I mean, these are large companies with established, well-established sustainable finance frameworks. And it seems that investors are generally like more comfortable with these issuers. I think where there's more scrutiny is for the issuers in harder to abate sectors. There tends to be a lot of scrutiny and in terms of their sustainability reporting, the matrix they use, if they're issuing SLBs, how credible are their KPIs and all that. But I think the opportunity here is that for these issuers, I mean, if they do put together a credible framework and they keep up their commitments in terms of post-issuance reporting, it seems that the premiums for these instruments can be very significant compared to other sectors.
And I don't know, Kathy, from your perspective on the social side, does it lend itself better, or do you find it is could it being included in all sectors, or does it lend itself much better to some sectors rather than others?
I don't know if I'd say there's any sectors off the top of my head that would be excluded. I think in some sectors it's easier to identify a target population, so that might make it a bit easier. So in terms of reporting, I feel like you would see FIs being able to disaggregate data a little bit easier by women or by loans to micro businesses, SMEs, things like that. So I feel like it might be a bit easier there once they have the system set up to be able to have that reporting ongoing. But I don't know if there's any particular sector that I would say has more trouble than another.
Thank you. And another question is, do we see more or less convergence in ESG benchmarks over time? So do you think the way that they're approaching the analysis is becoming standardized, or do you think they're kind of everyone's sticking to their own field? Christina, you might be able to help us with this.
This is such a sticky one, for us too. I think there's always been a lot of fragmentation with the ESG scoring. I think that's been a very fair critique of ESG scores and benchmarks. I do think that the market is kind of converging around thinking about ESG in terms of, what is the biggest factor at play here is I think the market has kind of coalesced around like the E side. Like of course, social is very important. Of course, governance issues need to factor into these scores and benchmarks, but we all need to have like this common understanding of what it means to lead us towards a resilient, climate resilient and a low carbon future. And so at least at S&P, with a couple of years ago, S&P acquired Shades of Green, which is now our benchmark as we're looking at projects on the green and social, or excuse me, the green and sustainable bond side of how these project figures are kind of getting us more from a principle-based approach towards that Paris-aligned future, and then thinking about how the social co-benefits are there to support that. So I think that's one way that I see that a lot of ESG kind of score providers are looking at this. But yeah, I think there's still a lot more work to do in developing a common language for how we talk about ESG. Absolutely.
Excellent. And as we're drawing close to time, there is one other question which talks about are there any recent investments in defence affecting the climate bonds? And this is actually I think it's all of the panelists are more than welcome to share their opinions on this, but it is one of the key themes that we think is pertinent for the 2025 outlook. And one of the highlights that we have alluded to in our upcoming report from the Global State of the Markets 2024 report as what we see kind of influencing the landscape in the coming years, because we are seeing so many announcements from different governments as to their plans for defense spending. So I don't know if anyone wants to talk about that, but it's not something that we have necessarily seen so far, but it is something that we predict will happen more and more. I think to round up, I would love to ask the panel what their kind of wish list would be, and maybe a couple of predictions for 2025 and beyond, what your wish list would be for really steps to kind of move the reporting landscape a little bit further. Christina, will we start with you again?
Sure. Yeah, I mean, not to sound like a broken record, you all, but my key wish for the future of the labeled bond market is really for improved standardization in that reporting. Because I think ultimately that's what translates us towards more decision useful investment decisions and getting financial flows going towards the most impactful projects based on comparable credible data, which is really important. I think there are a few ways we get there. One, definitely through some more engagement, I think, between asset managers and their issuers, the issuers who they are investing in for these projects. I think asset managers should make it very clear, express frequently and adamantly, just how critical this data quality is for them to continue making their decisions and reporting up to regulators and their asset owners. I think that's going to have a chain effect there. And then also, post-issuance external reviews. I think these are really important for accountability reasons. And we'll continue to try our best to play an essential role there in improving transparency and market integrity. And maybe just, my thought about where we're going in the future. In the next year, there's tremendous potential, I think, in advanced technologies that we're seeing. The AI-enabled databases that give us more precise figures or projections, I should say, on what the impacts and allocations are, even before an issuer has reported on them. And then, also there's always talk about remote sensing, which could really help ag-related projects. So I think these tools are definitely game changers, and hopefully will only become, we'll see more developments about them over the next couple of years.
Thank you so much. Kathy, will we go to you next? What's your wish list for 2025?
Sure. So I'll stick to my wishes. I don't know about predictions. That might be too difficult, but for a wish list, I feel like from the social side, I feel like for people to acknowledge what's feasible on social and to have a better understanding of what issuers can actually report on. I feel like sometimes there's a lot of discussion about these huge types of social impact studies that are needed. Let's just talk about what can actually be done and reported on. I would love for us to kind of hone in on that. The second thing would be for just in general, to stop making excuses on social. I feel like so often we hear, it's earlier, it's less developed. It is going to be less developed until we focus on it. So I feel like kind of really giving it the attention that it needs to grow. And then the last thing I feel like kind of on the same note is, I mean, it's not starting from scratch. If we can leverage expertise that already exists for a lot of these different sectors and types of projects and pull them into this type of reporting. I would love to see kind of the connection of those different worlds happen a little bit. I feel like that could move things further along.
Thank you so much. And very, very wise words. We just need to start making a move. Samuel, would you like to share your thoughts?
Sure. I don't think I have anything further to add in terms of the post-issuance reporting side of things. Kudos to the CBI team. I think the report has done a great job in outlining the current state of the market, and they're very good recommendations as to how to move things forward as well. And fully agree with the points that Christina and Katie have made. But maybe from a different perspective, looking at the broader sustainable finance market, my wish list would be, I think, to see a clearer and more commonly accepted definition of transition finance, which especially in Asia Pacific would be critical in the path towards decarbonization. As we know, companies in these hard-to-abate sectors require significant funding for the transition to a low-carbon economy. But I read a statistic somewhere that currently only 3% of all labor bond issuances are from entities in these sectors. So it's very low, but at the same time, there's a lot of potential. And having a widely accepted transition taxonomy, I think, can significantly move the needle in our path towards net zero.
Excellent. Thank you so much. Well, as we're touching upon the hour, I just want to say thank you so much to all of the panelists, both for joining us at the very start of your day and hopefully at the very end of your day, Samuel. Really appreciate your support and participation and the time taken. It has been hugely appreciated. And I invite everyone to look at the report, comment on the report, and share the report. And look forward to being in touch with you all again in the near future. Thank you so much.